Silver hit $121 an ounce on January 29, 2026. Then in 2 days, it crashed nearly 50%. Gold touched $5,600, then dropped over $200 in 48 hours. The mainstream media called it a correction. Wall Street called it a blow-off top. But here is what nobody is telling you out loud. The same forces that pushed silver to $121 are still in place today. The supply deficit is still there, the institutional money is still there, and the structural shift in how the world values silver, that is still happening right now. This video is about what actually happened, what is still happening beneath the surface, and why gold is now following a script that silver wrote first. Stay with me because this is the part most people are going to miss entirely. Most people think the silver story started in 2025 when prices exploded. That is the wrong starting point. The real story started in 2021. That is the year the silver market entered a structural supply deficit. A deficit means the world was using more silver than it was producing. And this did not happen for 1 year. It happened for 5 consecutive years in a row without stopping. The Silver Institute released the official numbers. The cumulative deficit from 2021 through 2025 now stands at nearly 820 million ounces. To put that in plain language, the world consumed almost 10 months' worth of total global mine production, more than it actually pulled out of the ground. That metal had to come from somewhere. It came from above-ground stockpiles held in vaults in London, Shanghai, and New York. And those stockpiles are not infinite. They were drawing down year after year while the public was focused on other things. Here is the part that makes silver different from gold and makes this deficit more serious than most people understand. Around 58% of all global silver demand today comes from industrial use. Solar panels need silver paste to function. Electric vehicles need silver in their electrical systems. AI data centers require silver in their circuitry and connections. Every one of those sectors is growing fast. Every one of them needs silver. And here is the problem on the other side of the equation. Mine supply has actually gone down, not up. Global silver mine production dropped from 1.07 billion ounces in 2010 to roughly 1.03 billion ounces in 2024 and 2025. The world is demanding significantly more silver while producing meaningfully less of it. That is a structural problem, not a temporary one. Now here's why this matters so much right now. Most silver is not produced from dedicated silver mines. It comes out as a byproduct when miners are digging for gold, copper, lead, and zinc. That means when silver prices go up, mining companies cannot simply flip a switch and produce more silver. They are constrained by what the primary metal is doing. Supply is relatively unresponsive to price increases. This is unusual in commodity markets, and it is one of the core reasons the deficit kept building even as prices were rising. Silver started 2025 around $29 per ounce. By October of that year, it had hit a new all-time record of $54.48. By the end of December, it closed above $70. For the full calendar year, silver gained nearly 147%, the biggest annual gain ever recorded for silver as an asset. Gold gained 64% in the same period, which itself was the best calendar year for gold since 1979. And yet most retail investors in the United States missed almost all of it. The media was not talking about silver in January 2025. The financial television channels were not covering it, but institutional money was already moving in ways that are now very clear in hindsight. Sprott Physical Silver Trust raised approximately $1 billion in fresh capital during 2025. Fidelity International doubled its gold holdings and publicly called silver the undervalued monetary metal with leverage to growth. Saudi Arabia made its first ever purchase of the SLV Silver ETF, a sovereign wealth fund treating silver as a reserve asset for the first time. Russia and India added physical silver to their national reserves. These are not retail investors buying coins on the internet. These are the largest pools of capital in the world, quietly repositioning into silver before the general public understood what was happening. The gold to silver ratio peaked above 107 in early 2025. That ratio measures how many ounces of silver it takes to buy 1 ounce of gold. A high number means silver is historically cheap relative to gold. As 2025 progressed and institutional buying accelerated, that ratio fell to 78 by October. Silver was catching up to gold, and the shift was only getting started. January 2026 was the most extraordinary month in precious metals in over 4 decades. By January 29th, gold had reached a new all-time high of $5,586 per ounce. Silver had reached a new all-time high of $121.64 per ounce on the same day. Both metals had been in a nearly vertical climb for the entire month. Gold was up nearly 29% in January alone. Silver was up over 68% in that single month. The rally had become parabolic, meaning it was accelerating faster than the fundamentals could justify in the short term. Then it collapsed in less than 48 hours. On January 30th and 31st, gold lost more than $1,200 from its peak. Silver crashed from $121 down to below $75, a drop of nearly 40% in 2 trading days. Silver's single-day percentage drop on January 31st was the worst since March 1980. By February 2nd, silver was trading around $81 per ounce. Gold futures fell below $5,000 for the first time since the rally began. The media gave you a headline: correction, profit-taking, overheated market. Some of that is technically accurate, but it is not the full picture. There were 3 specific forces that turned what should have been a normal pullback into a historic crash, and understanding those 3 forces is critical to understanding where this market goes from here. The first force was the Federal Reserve Chair nomination. President Trump announced he was nominating Kevin Warsh to replace Jerome Powell when Powell's term ends in May 2026. Warsh is widely known as a monetary hawk. He favors higher interest rates. The moment that news hit the market, the US dollar strengthened sharply. A stronger dollar is negative for gold and silver because both metals are priced in dollars. A stronger dollar makes them more expensive for foreign buyers, which reduces demand. The second force is the one nobody put in the headline. The CME Group, which operates the COMEX exchange where gold and silver futures are traded globally, raised margin requirements directly into the falling market. Gold margins went from 6% to 8%. Silver margins went from 11% to 15%. In plain language, anyone holding leveraged positions in precious metals futures suddenly had to put up significantly more cash or close their positions immediately. This triggered forced liquidations across the market. Margin calls went out at scale. Traders who were not panicking were forced to sell anyway because the exchange changed the rules mid-move. The CME raising margins into an already declining market is a mechanical accelerant. It does not create the direction of the move, it amplifies it dramatically. The third force was cross-market contagion. JP Morgan analysts specifically flagged that approximately $1.7 billion in cryptocurrency liquidations were happening simultaneously. When leveraged traders face margin calls in one asset, they often raise cash by selling whatever else they hold. Gold and silver positions got sold to cover crypto losses. Correlated selling across multiple asset classes at the same time made the precious metals drop significantly worse than the fundamental picture alone would have justified. U.S. Treasury Secretary Scott Bessent publicly attributed the crash to Chinese speculative traders, calling the January rally a speculative blow-off. That framing is politically convenient. It places the blame overseas and suggests the market simply got irrational. What that framing completely ignores is the 5-year supply deficit, the sovereign wealth fund buying, the central bank accumulation, and the structural industrial demand. None of those things reversed because of a Fed nomination. The crash was a leveraged unwind event. The fundamentals did not change in 48 hours. The SLV Silver ETF saw more than $40 billion in trading volume on the crash day alone, making it one of the most traded securities in history on that single day, exceeding the combined trading volume of Apple and Amazon. That is not a market being abandoned. That is a market with massive institutional attention, and large players were using the dislocation to establish new positions. After the crash, gold bounced back toward $5,100 by February 11th. Silver recovered to the $82 to $86 range. Both metals remain dramatically higher than they were 1 year ago. Gold up approximately 65% year over year, silver up over 155% year over year even after the crash. The crash erased weeks of gains. It did not erase years of structural change. Here's the more important story. The behavior of gold right now is telling you something specific about where silver goes next, and it is the same message that silver communicated to gold throughout all of 2025. Gold does not normally move the way it moved in 2025. Its long-term average annual return is 8% to 10%. In 2024, it gained 25%. In 2025, it gained 64%. Those numbers do not happen by accident, and they do not happen without a reason that is durable and structural. The reason is central bank buying at a scale the world has not seen in modern history. In the third quarter of 2025 alone, global central banks purchased 220 tons of gold, a 28% increase from the quarter before. The National Bank of Poland added 83 tons in a single year while targeting 30% of its total national reserves in physical gold. Kazakhstan, India, Turkey, and China all added to gold reserves. The World Gold Council reported that October 2025 was the single largest monthly central bank gold purchase of the entire year. Why are central banks doing this at record prices? Because they are reducing their exposure to U.S. dollar-denominated assets, primarily U.S. Treasury bonds. This is the de-dollarization process that analysts have been discussing for years. It is no longer theoretical. The data shows it is happening. And as central banks move out of treasuries, they need a reserve asset to replace them. Gold has been the answer for thousands of years. The difference now is the pace and the scale. On October 31st, 2025, the BRICS Alliance launched a gold-backed currency pilot program. As of late 2025, BRICS nations controlled approximately 50% of global gold production. The infrastructure for dollar-free trade settlement is being built transaction by transaction. This is not a fringe development. This is a structural reorganization of how global trade and reserves function, and gold is at the center of it. Now here is the connection between gold and silver that institutional analysts understand and retail investors almost never discuss. When gold moves in a sustained bull market, silver moves more. Silver acts like leveraged gold. It follows gold's direction, but with larger percentage moves in both directions. In 2025, gold gained 64% and silver gained 145%. Silver moved roughly twice as much as gold. This is a consistent historical pattern going back decades. Goldman Sachs currently has a 2026 gold target of $5,400 per ounce. JP Morgan has upgraded its forecast to $6,300 per ounce by end of 2026. ANZ Bank raised its Q2 2026 gold target to $5,800, explicitly calling the recent correction an opportunity for fresh investment and stating that the rally is not yet mature enough to reverse. Deutsche Bank wrote after the sell-off that gold's thematic drivers remain positive and investor rationale for holding gold allocations has not changed. A Reuters poll of 30 institutional analysts now puts the median 2026 gold forecast at $4,746 per ounce, the highest annual consensus in the history of that survey going back to 2012. That same survey 1 year ago forecast gold at $2,700 for 2025. Not a single major institutional forecast was revised downward after the crash. Every single one was revised upward. That is the signal most people are completely missing while watching daily price charts and reacting to headlines. The gold to silver ratio after the crash moved back above 60. If gold moves toward the institutional targets and the ratio compresses back toward historical norms, the math on silver becomes very significant. Gold is not telling you the bull market is over. Gold is telling you the reset happened, the leverage got cleaned out, and the structural trade is still intact. Here's exactly where this market stands right now in February 2026, without the noise and without the spin. Silver is trading in the $82 to $86 range after crashing from $121. Gold is consolidating between $4,900 and $5,100 after crashing from $5,586. The 5-year cumulative supply deficit in silver is real and still building. Mine supply cannot meaningfully increase because most silver is a byproduct of other metal mining. Industrial demand from solar, EVs, and AI infrastructure is not slowing down. It is accelerating. Central banks are still buying gold at record pace. The dollar remains under long-term structural pressure from de-dollarization. And every major institutional gold forecast has been revised higher since the crash, not lower. The crash did one important thing. It forced the leveraged, speculative positions out of the market through margin calls. The traders who were using borrowed money to chase the January rally got wiped out or forced to sell. That is actually a healthy development for the long-term bull case. When leveraged speculation gets cleared out, what remains is structural demand from buyers who are not going to panic sell on the next volatile week. JP Morgan projects silver averaging $81 per ounce across the full year of 2026. Some independent analysts consider that conservative given the ongoing supply deficit and the industrial demand trajectory. The Reuters survey now forecasts a 2026 average silver price of $79.50 per ounce, up from a $50 estimate made just 4 months earlier in October 2025. These revisions are happening fast because the fundamental picture keeps reasserting itself even after violent short-term dislocations. Now here is what most people get wrong when they look at this market from the outside. They watch the price daily. When it goes up, they feel good. When it drops 40% in 48 hours, they panic. And then they sell at exactly the wrong time. This is not new behavior. It is the same behavior that caused retail investors to miss the 2009 to 2011 silver bull market. In that cycle, silver doubled again after breaking through its prior all-time high. The investors who held through the corrections captured that move. The ones reacting to daily headlines did not. The fact that the U.S. Treasury Secretary publicly blamed Chinese traders for the crash is itself a data point worth paying attention to. When a senior government official publicly assigns blame for a commodity price move, it usually means that move created a problem worth managing politically. Silver rising from $29 to $121 over 13 months is not something that goes unnoticed in Washington. The COMEX margin hikes, the public statements, the framing of the crash as pure speculation. These are responses to a move that was becoming disruptive to the existing financial order. That disruption did not happen because silver is irrelevant. It happened because silver was being recognized as something important by very large players. Think about what actually happened on the crash day. The SLV Silver ETF traded more than $40 billion in a single session, more volume than Apple and Amazon combined on the same day. That level of activity does not come from retail investors selling out of fear. That level of activity represents institutional players taking positions at scale. Some were selling, others were buying. The people who understand what a leveraged unwind looks like versus a fundamental breakdown were using that day as an entry opportunity, not an exit. The silver shift they are not telling you about is not a price target. It is a structural repositioning of how the world's largest pools of capital view this metal. Sovereign wealth funds buying SLV for the first time. Central banks treating silver as a reserve asset alongside gold. The BRICS pilot for a gold-backed currency unit pulling demand away from dollar-denominated alternatives. Industrial sectors with no silver substitutes growing at double-digit rates while mine supply stays flat. 5 consecutive years of deficits, drawing down above-ground stockpiles that cannot be rebuilt overnight. Gold hit over 50 new all-time highs in 2025. That is the environment silver operates in. When gold is making institutional investors globally rethink their reserve allocations, when central banks are buying at record prices and still being replaced on the buy side by the next central bank, silver does not sit still. It has historically moved with gold, but faster and further. The question right now is not whether you missed $29 silver. That question is irrelevant. The question is whether $82 to $86 silver looks different after you understand the 5-year deficit, the institutional repositioning, the central bank gold buying, and the fact that every major forecasting desk raised its gold targets after the biggest 2-day crash in 43 years. If those desks still see $5,800 to $6,300 gold ahead, and the gold to silver ratio still has room to compress, then the silver shift is not behind you. It is still in front of you. That is the part they are not telling you. And now you know exactly what it is doing to gold right now.